Hey traders, Steven Kowitzel here. It is Thursday, October the 4th. Man, we got some exciting and not in a good way. So we're going to cover that most importantly because the market is breaking what looks like 5-month support line. So we're going to go through that. We're going to cover a lot. We're going to look at the breadth. We're going to look at the price action. Really, we're going to talk about some rules about how to protect yourself if this gets a little nastier. Because I think the most important thing when the market is starting to be a little indecisive is to make sure that you're being a little bit proactive. That doesn't mean sell everything. That just means taking notice. And then as the market gets uglier, don't make an all or none decision. You can slowly raise your stops, let them get hit, move to cash, because you don't know, if this is going to be another January where now support breaks and then you just start to have that waterfall effect. So let's really just start in the Nasdaq right here, and you can see clear as day that the 50-day moving average will just continue to find support. What's interesting, and now support is broken, right? Or at least as of about an hour to the close. Maybe it comes in a little bit. So it's important, one, to just make sure you're very aware of what's going on, and two, not to also overreact. Because this right here, this pullback right here, it was incredibly ugly. You had reversal, gap, another reversal, and then it firmed up and just continues on its trend, right? So it's important not to overreact to these normal pullbacks, although I do believe this is more of a corrective type of price action. And just, make sure that you're not making all or none decisions, or at least I don't. I try not to, because typically the minute I, throw in the towel and say, oh, I need to get out of everything, well, that's the minute I probably should have stayed in something. So, let your weakest positions tell you which ones you need to be getting in and which ones you need to be getting out of. So right now, you can see right here, this whole consolidation right here, there has been a ton of activity, a ton of volume, a ton of tugging and pulling, and that happened over here too. So what was a little bit different about this one, which is why maybe you should have already reduced some of your positions, at least the ones that you weren't up a lot on, is because you continue to see the market closing weak, right? You see it popped up on this day right here. It closed in the lower half of the day. Same thing right here, and then it got slammed, found support, gaps up, another reversal. Find support, and then you get all these closes at the end of the day, even on up days. This happened 1, 2, 3, 4, 5, 6, probably 7 days in a row where the market just continues to sell off into the close. And that's just showing fatigue. So when you start to see that, that's why I try to place most of my trades, in the final hour of the day, because I don't really care where the market opens. I care where it finishes. If it starts weak and finishes strong, that's awesome. That's what I want to see. If it starts strong and finishes weak, well, then eventually you're going to get a crack if you have enough of them, just like we have too. Because you can see right around this, 8,075 or between 8,050 and 8,100, it kept finding resistance. It just could not get there. And now you have a crack of the 50-day moving average. I just kind of want to update this. So the Nasdaq is down 2%. Now, there is nothing wrong with this. And I know that, I'm supposed to, always say stocks should go up. You got to make money here. You got to make money there. You are going to make, as long as you can keep the whipsaw small, right? Whipsaw is a part of trading. It's going to happen. I always refer to Ed Sekoda's quote, and he's, one of the famous traders of all time. He's like, if you don't like whipsaw, don't trade. So the important thing is to notice when you're starting to get whipsaw in that indecision. You look at the evidence, right? And then at that point in time, if you continue to trade, you just want to make sure your losses are really small. That way, you can get hit at a few trades in a row But as long as your losses are, 4% or less, that's not going to hurt your account at all. So at least if you have, kind of an equal weighting on some of your stocks. So, typically how I do it is if I'm noticing, whipsaw, all of a sudden the market, you can make money, and then you're getting whipsawed towards the top. And even though the market is almost at an all-time high, you're noticing that the stocks are going up a little bit and then triggering you out. When I have 3 losses in a row, I'm going to cut my position size in half. I'm going to go from a quarter of my account to 12.5%, or, approximately an eighth of my account in a trade, because either a couple things are happening. One, either I'm off, or 2, the market is off and is trying to tell me something. Either way, and if 1 or 2 does not hold and I'm wrong and then the market takes off, well, I still have some stock. I'm still trading. I'm just trading smaller positions, and then you can go back to a full position. So it's always helped me, and it's part of the kind of the IBD philosophy to not try to overtrade, or to not have to feel like you have to get it all in or you have to get it all out, because that was a mistake that I used to make. I used to always feel that the minute, I used to call it's the big one-itis. Right? It means that every little pullback, I thought something big was going to happen, so I'd sell everything, and I should have kept it. So I'm continuing to talk about this, but focus on your individual stocks. If your individual stocks are hanging in there, I don't really see any reason to go out and heave them. If they're starting to break, as I've noticed a lot of growth stocks breaking early in the week, like breaking their 50-day moving average. And as I stated, it was either last week's webinar or earlier this week to my subscribers, typically growth stocks, they are the first to go. You start to see weakness in some of the biggest winners early. Now, when that starts to happen, sometimes it can find its footing and it can come back. But then when you get that followed by a price break, now it's time to pay attention. Price and volume trumps everything, but all the secondary indicators, you have to pay attention to the evidence. So the Nasdaq is breaking here. Let's look at the S&P 500, because I have a lot of charts to go through. So I've always talked about personality changes. This is nothing new. You pay attention to the market until the personality changes. You have the S&P 500 that has just been in this channel forever. Every time it hits the upward channel, it pulls back. Well, ever since, so you kind of had a wide channel right here, and then after that, it is fully in the top half of this channel. So a very, very strong trend. Now it appears to me that channel line could be probably breaking. Even if it does and it comes down to 2860, that's still a normal pullback. That doesn't mean, horrible things are going to happen. If it starts to break that, it kind of starts to break this pivot right here, the 2850, 2860 zone, which I would think would be the first line of support, then I think we're obviously in for something deeper. So, it's important to keep an eye on everything and take it day by day. So the S&P 500 is looking a little weak. Let's look at the breadth as well. So I think this is end of close, I assume. The overall breadth for the bigger trend is still up. 70% is still bullish. I assume that after the close, this is going to come down a little bit. I don't think this is an intraday chart. But you can see the percentage of S&P 500 stocks above the 50-day and above the 20-day are kind of already in that, sideways middle type of action, meaning you're only having about half the stocks push up the market. So the other half is slowing everything down a little bit. And typically when breadth starts to weaken and the market goes up, that's a negative divergence. So we're at a negative divergence in the short term. In the long term, this is still bullish. So I'm not going to cry uncle here, but if this, trend line breaks across here on the bigger breadth indicator, then, correction could be had. Let's look at the Nasdaq breadth. Where is that? This is just kind of one of those secondary indicators that can tell you in a little bit in advance. You have the Nasdaq composite right up here, right? Trend line broken right around here. I could just really draw this right across here. And let's just kind of get a trend line. Doesn't have to be pretty, but the trend line broke. But the interesting thing is the Nasdaq advanced decline line. I mean, that weakened way before, or I say way before, several weeks before the price action weekend. So even though they topped together, as the composite was trying to bounce, the breadth got weaker. The advanced decline net issues got weaker. So again, you know, now you're starting to pay attention to be like, okay, when you see all these, then you wait for the price action, because you can always find a negative divergence in a bull market or a rally. Always. Almost always. I can always find a bearish case for something. So when the price breaks, you know, and maybe when you start to see a lot of negative divergences, maybe you just cut back a little bit, or even just hold off on new positions until it figures itself out. But then when price breaks, then you should probably be taking at least some action if you have some short-term money that is at work right now. So if we look at the relative chart of the S&P 500, and this is something I've been showing you, and not surprising. Now, the S&P 500 is still, I mean, a stone's throw away from an all-time high. This is not a correction by any means. I think it could become a correction, but it's hard to look at the price action and say that's bearish. But, you know, going all the way back to the beginning of July, the small caps have underperformed significantly. Small caps have sold off. And that also has to do with the dollar this weekend, even though it's starting to bounce back. The Nasdaq is starting to lag, okay, and has been lagging the S&P 500 after outperforming for quite some time. And the IBD 50, which is the growth stock indicator, that's been all underperforming for the last few months. So you don't have to make trading decisions off these secondary indicators, but they're always important to just, you know, the evidence to look at, to have in the back of your mind when you do start to see price breaks. So let's look at I do want to look at the Russell 2000 chart, because that is all sorts of ugly. The small caps right here. So when the Nasdaq and the S&P 500 was looking a lot better, you can see small caps really just sold off. They are already in a corrective territory. Let me just kind of measure this real quick. Just about a 6% correction. I think it's right at a 6% correction from high to low. I mean, that's a pretty good pullback. So it's even not that ugly. It's starting to come in a horizontal support close to the 200-day moving average. When I see the Russell 2000 outperform, I don't typically always consider that a negative divergence when I see them underperform, just because I continue to try to compare them, and I think sometimes small caps have a mind of their own, and I don't always notice an underperformance or outperformance as really a whole lot of meaning. Maybe somebody else does, just because, you know, the dollar plays a big role in small cap outperformance. When the dollar is strong, typically small caps outperform because large caps underperform, because most of, or at least half of sales in large caps are from international. When the dollar is strong, you know, they have problems selling more goods. So this is weak, and this broke support a while ago, and now the Nasdaq is breaking support. S&P 500 is still the strongest. It is not there yet. It is just in as of right now, a light pullback mode. One thing I do want to do is just kind of go back to the Nasdaq real quick. Let me kind of go back a little bit further to remember really what happened earlier this year. So you have the market just, this is what I call the waterfall, right? It just goes straight down once you have that first gap, and then you get a week, 2 weeks down of straight selling. You know, you had a waterfall right here where it's just hard selling pressure. But we're still in a bull market, and most of the cracks like this do not turn into a waterfall. This was pretty ugly, and then it firmed up. This is pretty ugly. Right here, right here. They're all ugly for 2 or 3 days when they're pulling back hard. This, I do believe, is a little different because it's not like a pullback and a bounce. It is a pullback, a failed breakout, then a crack. So we're just going to have to continue to watch it. But when this happens, you do not want to be on the wrong side of this. So I'm not saying this is going to happen, but you always just want to be prepared for every scenario and not freeze. Stops are incredibly important. I am just pulling this number out of anywhere. I'm not 100% sure, but it seems like, at least with me, when I get stopped out, 2 out of 3 of those stops eventually come back pretty quickly. But it's that 1 out of 3 that is just devastating. And I truly believe that drawdowns are one of the single biggest components to growing your accumulating wealth over time. If you can I like to keep my drawdowns at, no more than 10%. I have several of them, but once I get that 10%, drawdown, something is wrong. But if you can beat the market and have a half of the drawdown of the market, your equity curve is going to smoke what just holding the S&P 500 would do, because you're not having to play from behind the way the overall market is. So my point is, don't get frozen. It's okay to get stopped out. Keep the losses small. And when you're unsure whether to sell something or to not sell something, sometimes I just sell half. Like, I'm just unsure which way to go. Is this going to be the bottom? Is this just a VIX thrust to the upside, buying opportunity? If I'm unsure, it just makes me better to sell half. Because if you sell half and then it continues to go down, well, you lowered your loss, you cut your loss in half. Whereas, if it continues to turn around and you just sold half, great. You still got money that is going up, right? So we'll just kind of keep an eye on this, but I don't like this action at all. Just because it's a 1, 2, 3, 4, 5 month trend line. 5 month trend line is breaking. So let's look at some bonds. The market's so exciting. No one wants to talk about bonds, but this is the TLT iShares 20-year bond. You have a false breakout. Okay, so bonds have been in a bear market. The bond prices, the treasury yields have done just fine. We'll look at that here in a second. But, it's been in a bear market really since way up here in the middle of 2016. You had a bear market rally, but you have a double bottom, and then when it was trying to break out, I remember this, and I remember saying it needs to have a definitive breakout above this horizontal right here. It never happened, so then you had a false breakout. And one thing I've always learned from Martin Pring from stockcharts.com is he always says that a false breakout or false move is an above average move the opposite way. So if you get a whipsaw to the upside and it just turns around and gets rejected, it could be an above average move to the downside. Same thing with a whipsaw to the downside. If this undercuts this, which I'm assuming this is going to continue, but if you have a false breakdown and then it goes out, like kind of what it's looking at in the dollar, you could have an above average move to the upside. So if we look at treasury yields, so bonds are, let's just go to treasury yields. So bonds are positively, I'm going to remind you, positively correlated with utilities and REITs. So bonds are going down. Typically, REITs and utilities are going to go down with it. Because if bonds go down, yields are going up. And when yields go up, typically that's not great for utilities and REITs. These are high debt type of companies, right? Very high capital infrastructure, so they just don't typically do well in high interest rates environments. So if we go to, let's go to, where is that dang thing? TNX, okay. Man, to me, this is a definitive breakout. This is a 44-year chart. Sure, I could shrink this a little bit, but you know, it's so important to know where we're at least in my lifetime. I mean, this peaked out in 81, and then started a secular bear market in yields, which is a secular bull market in bonds. I'd say this is definitive right here. Yields are rising, should be long-term positive for financials. Let me kind of just shrink this. Let me just kind of go to a smaller chart. So now we're just kind of looking at a 25-year chart thing. But look, right here, you have a 7-year inverse head and shoulders the way I see it. And then a breakout of a downtrend, all right at the same pivot from 30 to 32. That's in 10-year yields of 3 to 3.2. And that looks bullish. That doesn't mean it's going to go straight up, go off to the moon. These are long-term charts. But if bonds, I mean, really over the last 35, 40 years, you would have done well in bonds, owning bonds. And now if that trend is reversed, I think over the long term, bonds, you know, could underperform. So I want to show you a long-term chart here in a second of the stock market. We talk about long-term trends. So if yields are positively correlated with financials, you can see they're in the upper half of this pane. So most of the time they are going in a similar direction. The XLF, this is the XLF ETF, the financials ETF. If yields are going up most of the time, financials are going up, and most of the time utilities are going down, because you can see utilities have been negatively correlated right here. So, and I always try to talk about, people think they are safe in conservative investments, and you know, safe is open to being objective and looking at it a little bit. You know, my idea of safe is, you know, making sure I outpace inflation. Someone else's idea of safe might be, you know, the company that it owns, but that company could underperform for years and years because it's a utility. So I think if you have a long-term view, you want to try to outperform inflation. Like, that's why we invest, to grow real wealth. Real wealth is, you know, the growth minus the inflation. So if we're going to stick with the theme of long-term charts, let's look at a 100-year chart of the S&P 500. Now, this is so important. And when I used to be a financial advisor and a money manager, this was just a chart I always would show people. So you have historical periods where the market just did absolutely nothing. So you have the Roaring 20s. It peaked in 29 and did not, the S&P 500, this is a monthly chart, did not get back to that peak until 1955. Now, if you're buying cheap, you did really well, right? But let's just think of it in terms of stair-stepping its way higher over time. Then you have phenomenal growth years, right? Where you just have double-digit returns average in the market. And then you have another consolidation. And then you have the 80s and 90s. And then you have another consolidation. So end of 13 to the peak in 2000 to the end of 13 years, if you would have bought at the top, it's about how long it would have taken you to got back to the high. So for 13 years, you'd have been stuck in a box earning your small dividend. Now we are, let's just say, almost 5 years into this rally. So these are secular bull markets. You have a secular bull market, you have a secular bull market, you have a secular bull market versus secular bear markets. Okay. Why am I showing you this? Because the talking heads out there are saying this bear market this bull market hadn't had a bear market since 2009. So they're going to say it's a 9-year-old bull market. I'm looking at it when I look at this chart and say, well, maybe it's been 9 years till the S&P 500 hasn't had a 20% correction, even though the small caps have. But if history is a guide, looking at this 100-year chart, we are early in the secular bull market move. So anyone I talk to, I try to say, look, you don't know if this is going to drop. You don't know if it's going to fall into another one of these for a long period of time. But if history is a guide, you're going to be sideways for a long period of time, then you're going to be up for a long period of time. If you miss, during your accumulation years, if you're missing this growth, this bull market, that's going to crush. That's going to crush your wealth over time as far as the potential growth of your wealth, right? So my point is to make sure that you know where we're at in history. And I believe if history is a guide, we still have more to go. Now, there can be cyclical bear markets and secular bull markets. That doesn't mean we cannot have a bear market. There were plenty of bear markets along the way of the 80s and 90s, but it just kept coming back. So that doesn't mean that just if we get a 20% correction, doesn't mean the secular bull is over. I don't think it's over. I think if we could have a bear market, I even think a really nice correction, even a bear market might be healthy just to reset the debt. Because the greatest, if you know when to enter towards the bottom, there's some of the greatest gains, right after a bear market is over, right after everyone is just scared as can be. Those are some of the greatest gains for the next 6, 12, 36 months. So I'm showing you this to show how important it is to have a plan. Now, if this falls, right, you need to have a plan. Maybe you use the death cross, the 10-week, under the 40-week, you get out, or you move to bonds, or something like that. So you don't want to just say, well, Steve says so I'm going to hold it, right? Things change. But I think it's important to look at history. So this is the S&P 500 versus the financials XLF. So I'm going to review this again. It's interesting that the XLF in 2018 has underperformed, because we're right over here in 2018, has underperformed the S&P 500 given the rise in interest rates. So it's not an exact science. There's an art to it. But for the most part, since this part, 2009, the financials have been trading in line with the S&P 500. One could even argue that since 2011, the financials have been outperforming the S&P 500. And right here, we had a breakout and it failed. Maybe we have another relative breakout again. But for the most part, we have a long ways to go to get to a roaring outperformance in banks relative to the S&P 500. It's important to look at this with interest rates doing what they do, right? With them breaking out and looking bullish. Financials are still lagging a bit, but I think it's important not to ignore them. Because when you're in a rising interest rate environment, typically that does favor financials in the long term. There can be plenty of bumps and bruises along the way. Now, I like to look at the XLE relative to the S&P 500. Obviously, so when a relative chart, when this line is rising, means energy is outperforming the S&P 500 and vice versa. You have the year 2000 to 2008. This is significant outperformance of energy stocks for 8 years, right? Significant. Double or triple probably what the market is doing. And energy has really been in a bear market relative to the S&P 500 ever since 2008. This is over 10 years ago. This was the summer of 2008. So what I look for is when you have these relative breakouts, right? It just continues to go down and down. we're close. This isn't going to happen next week, but you know, if energy, we are close to a long-term relative breakout that goes all the way back to 2014. So a 4-year chart, 4-year trend line. So it's important to kind of keep our eye on this because as we can see, the trends can last 8 years here, 10 years here. They can last for a very, very long time. Relative charts of sectors, if you look at the long-term historical, they are really, really good places to park some money when they're outperforming. When they're underperforming, then you just get out of the way. But I wanted to show you this just because how close I think it really is. Oops, I don't know what that is. So I do like to look at the 50, the Innovator IBD 50 ETF, just to see how it's doing, because these are the kind of stocks I like to trade. Yes, they're pretty volatile, but they can be fast movers. I mean, they started their waterfall already of 1, 2, 3 really, really nasty days. And like I said, you know, sometimes growth stocks are the first to go, and they've already started to crack. So, you know, we talk about this negative divergence. We've also had a big negative divergence in, you know, what international stocks have already been in a bear market, and the S&P 500 has just been roaring to an all-time high. So I'm just very interested to see how this plays out. Might be nothing, but they might eventually come together. I don't typically like this. I might put the brakes on new trades for a week or so, just maybe even longer. We'll just kind of wait and see. Speaking of long-term charts, let's look at a value versus growth chart. So there's always an argument. This is the iShares S&P 500 value ETF relative to the S&P 500 growth ETF. So value stocks, you know, financials, healthcare, utilities, you know, stuff like that. Even though healthcare is really strong right now, you know, growth stocks are cyclical. Your technology, your cyclical stocks, your industrial stocks. So you from 2000 to 2007, the peak, value outperformed growth, right, for 7 years. And really, since that peak, value has significantly underperformed growth stocks. Like, it hasn't even been close. And I read an interesting article on IBD, and they were talking about really one of the main reasons growth stocks continue to outperform value stocks is, I mean, the earnings are greater. And with really the rise of technology stocks, even more so in the last 5 years than in the previous 15, earnings and sales, I mean, that is where a lot of growth is. So, I mean, think about it. Do you want to own a laggard that's earning 5% growth, earnings per share, or, you know, some technology company that's got 20, 50, 100% growth rate? So they made an excellent case for why growth continues to outperform. Now, this could switch at any time. I think we all know that. But it made sense. So I bring that up to show you this chart, to show you how long value can outperform growth and growth can outperform value. And when a trend line breaks, it doesn't really, you can see value try to break out and then just above average move to the downside, right? So these trends can happen for a very, very long time, and you want to stay with it. You want to continue to stay with it. Life is long but short, and I'll say, like, our investing life, we do not want to be sitting in a laggard for 10 years, right? So if you have been buying a lot of international stocks in the last 6 or 7 years, probably underperformed significantly for a long time period. And there's just simple relative charts that can show you what the best one is, or at least from a momentum base. So, you know, buy strong is basically what I'm saying, is buy the ones, or at least look at the ones with good earnings, good sales. You can see the market's coming back a little bit. That's nice. That's nice. Let's look at the sector summary, and we'll probably finish up with that. So financials are up today, which I'm surprising based on the slaughterhouse that anything is up today. But financials and utilities are up. and then you have technology, cyclicals, communication is way down. Let's look on the 1 week. Energy. Energy continues to show a little bit of relative outperformance in the short term. It'd be interesting to see how, if we click on this, how long that can hold up. But, you know, once we click on energy and break it down by industry, energy does not mean coal. Coal has been down 14% in the last 1 week, whereas exploration and production, I mean, that is where a lot of, in the pipelines, the MLPs, that's where a lot of the strength is coming from. So always look a little bit further in the industry of the sector, because you don't want a big industry in a sector to drag down any outperformance of the whole energy sector, when you can just go out and buy a XOP or an XES or, you know, something that's done a little better. So I know we talked about a lot. I know we looked at some long-term charts, but I just think it's important to, and see the market's coming back a little bit. Well, I do mean just a little bit, but it's important to just know where your exit is for each individual position if things go a little bit further south than we expected.